Right, so I had a lot of people asking what futures contracts actually are, and it sounds confusing, but it's not confusing. I looked at futures contracts when I used to trade crypto, and I saw the word futures, and I was like, no, I'm not touching that. I don't even know what it was. I don't even want to know what it is, but it's quite simple. It's just like trading any other stock. So we'll break it down in this video, and by the end of it, you'll know. Right, so we'll do a deep dive into futures contracts. So basically, futures are a financial contract requiring parties to trade an asset at a specific future time and date. So the buyer must buy and the seller must sell the underlying asset at an agreed price regardless of its market expiration. Underlying assets include physical commodities or financial instruments. So physical is gold, silver, wheat, grain, oil. Financial instruments would be like your S&P 500, so ES, NASDAQ, which is NQ. Futures contract or futures mean the same thing. The example you might hear is somebody say they bought an oil future, which means the same thing as oil futures contract. Futures contract, so you're buying a futures contract in oil. You're basically just buying oil at that specific price. Usually it refers to specific type, like there we go, oil, gold, bonds, S&P 500. Futures contracts are also one of the most direct ways to invest in oil. The term futures is more general and is often used to refer to the whole market, such as they're a futures trader. So yeah, so if someone says I trade futures, like me, I trade futures, I'm a futures trader, then it's to the broad market. So you could trade oil, gold. I mean, I just trade the ES, S&P, but you could trade anything really. So what is a futures contract? So it's a futures contract is a standardized agreement between a buyer and a seller of an underlying asset, i.e. gold, oil, at a predetermined price, so whatever the price is on the chart at that time, and it's going to obviously be traded on a regulated exchange, so that'll be like the CME, which is the Chicago Mercantile Exchange. So this is why I like to trade futures, because everything's centralized and regulated, so there's no shady business going on. Every broker that you go with in futures all have the same prices, same slippage, it's all regulated under one body. So the mechanics of futures traded can lead to cash settlement or physical delivery at expiration date, adding another layer of consideration for our participants in the market. So if you buy, let's say you buy gold, and then the contract expires and you still hold that contract, you own that gold. In essence, you could have gold delivered to your front door. You physically own that gold if you hadn't settled in cash. Trading futures requires a margin account and usually involves complex risk strategies appealing to both retail traders and institutional investors. So institutional be pension, hedge funds, stuff like that, banks. But you don't necessarily need to have a margin account. You can trade a personal account, but what a lot of people are doing now, especially a lot of retail traders, we trade prop firms. So there's a lot less risk involved, but we'll go into that at a later date. So deep dive into futures contracts. Underlying assets involve physical commodities or financial instruments. So physical commodities being, like we said, oil, wheat, gold, silver. Financial instruments being S&P 500, NASDAQ, bonds even, the pound. Futures contracts specify the quantity of the asset and are standardized for trading on the futures exchange. Futures can be used for hedging or trade speculation. So we'll go into that next. Right, so exploring different types of futures contracts. So obviously, like we said, commodities, financial assets. So there's agricultural futures, energy futures, metal futures, currency, and financial. So I won't go in too deep, but if you want to have a read through them, pause it, have a read through them, and we can move on to the next slide. So, how do futures contract work, or futures contract work? How do futures contracts work? So imagine an oil producer plans to produce 1 million barrels of oil over the next year. It will be ready for delivery in 12 months, assuming the current price is $75 a barrel. The producer could produce the oil and then sell it at the current market price 1 year from today. Given the volatility of oil prices and the market price at the time could be very different. If the oil producer thinks that oil will be higher in 1 year, they may opt not to lock in a price now. But if they think $75 is a good price, they could lock in the guaranteed sale price by entering into a futures contract. So like we were saying before, basically you're buying at a price, and then in a year's time the oil might be $80 a barrel, but you've bought them at $75 a barrel. So if you're ordering a lot of barrels of oil, you're saving a lot of money by getting in at a lower price. So the process of trading futures contracts. So retail traders and portfolio managers are not interested in delivering or receiving any of the underlying assets. So we don't want gold or wheat, oil delivered to his door once the contracts expire. A retail trader has little need to receive 1,000 barrels of oil, but they may be interested in capturing the profit on the price move, that's what we want as a retail trader. Future contracts can be traded purely for profit, that's what we're doing, as long as the trade is closed before the expiration date. Many futures contracts expire on the third party. No, that's not right though, is it? Most contracts expire on the third Friday of every month. Well, we only swap over the contract numbers every 3 months, every quarter, so even though they do expire on that time, I'll have to look into that more, and we'll get into that when it comes to swapping over contracts on the chart. But contracts do not vary, so check the contract specifications of any and all contracts before trading them. Yeah. Well, I mean, we don't even hold overnight, especially using prop firms. You don't hold overnight, so you're only trading from market open to market close, so I won't worry about that. Why is it called a futures contract? So a futures contract gets its name from the fact that the buyer and the seller of the contract are agreeing to a price today for an asset or security that is delivered in the future, if you want the asset delivering, which we don't. Right, so what happens if a futures contract is held until it expires? Unless the contract position is closed out prior to its expiration, the short, meaning the seller, is obligated to make the delivery to the long, meaning the buyer, who is obligated to take it. Depending on the contract, the values exchanged can be settled in cash. Most often, the trader will simply pay or receive a cash settlement depending on whether the underlying asset is increased or decreased. So most people will opt for money. In some cases, however, the futures contract will require physical delivery. In this scenario, the investor holding the contract upon its expiration will be responsible for storing the goods and will need to cover the cost for materials handling, physical storage and insurance. So make sure you close out your contracts if you're going to be holding them for a long period of time, because you don't want 10 tons of grain turning up at your front door and have nowhere to put it. But it's not going to happen anyway, not in the way we trade futures, because we trade from opening bell to closing bell day to day. You're never going to be holding a contract for this amount of time. This is for big players, in the market, so don't worry about it. The bottom line, futures contracts play an important role in the smooth operations of the commodities market, so gold, oil, wheat, grain, stuff like that. They allow buyers and sellers to lock in the prices in advance and help farmers, miners, manufacturers and the other market participants work towards without having to carry out any daily changes in the market. The prices of the futures are affected by interest rate. So yeah, basically interest in dividend payments. So inflation, interest rates, stuff like this, especially when you're trading like ES, Nasdaq, the financial instruments, you don't trade through news because it can go from one side of the market to the other. So yeah, get out your positions when news is on, interest rates, when Powell's speaking, you don't want to be in it. So that's pretty much what futures are in a nutshell, but a lot of it doesn't really affect us. We just let's trading like any other stock. You're just trading, you're buying and you're selling, and that's all you need to know. Okay, that's it. Ciao for now.